Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, August 29th, 2018. In this video, we'll take a look at something a little bit different. We'll take a look at market breadth. If you're a follower of the YouTube channel or the public content on Right Side of the Chart, you probably haven't seen a market update in a while, and that is because there just absolutely hasn't been anything new to update. There haven't been any new developments. This market continues to grind higher, and we haven't broken any trend line support. We haven't put in any type of reversal candlesticks. So that's the story. I'm still watching the bigger picture on the daily chart of SPY. This uptrend line, it's the same one I've been highlighting for a while. SPY is still comfortably above that uptrend line. And then also this 279.67-ish level, which was the breakout of the all the highs that we've had since that, after that January high earlier. We broke out, back tested it. So I still think that's a likely pullback target in the first key support level on the next pullback. I think that's a minimum target heading down there, and we'll probably get a reaction off that level. And if and when we break that line and that horizontal support level, that would give us probably our next major sell signal in the markets. But we're far from that right now. QQQ, similar story, except QQQ is a little closer to its uptrend line, and this is even a little bit better defined. We have a lot of reactions along the way. So this is the trend line I've been focusing on recently on the daily chart. And you can see that we've had now one, two, three, four series of there, several candles, five, six, at least six reactions off that level. And I'm talking not just individual candles, clusters of reactions. So very well defined, very well watched level, I believe. And so until and unless that breaks, and it will, sooner or later, that'll give us a pretty powerful sell signal. We could get something before then, some type of candlestick reversal, but right now there is nothing in the market even remotely close to a sell signal. We just have green candles along the way for the last 4 days now. But as I continue to state, we clearly diverge. These divergences are not sell signals, far from it. They're merely an indication that a trend change is likely. And as I often say, you can take these divergence lines and continue to extend them. And as long as we don't take out that previous reaction high, we still have divergences, and we're guaranteed to have divergences even if the Qs were to push another 2-3% higher in the next couple days or next week or so here. You can see because the indicators are lagging so much. But again, nothing close to a sell signal now. But let's look at the bigger picture, and let's talk about market breadth in this video. I haven't done that in a while. All right, I'm going to jump over here to a chart covering, let's go first to a daily time frame. All right, so what I've done here is I've overlaid QQQ, the NASDAQ 100 tracking ETF in green, with QQQE, which is the NASDAQ 100 equal weighted index. So that gives you the roughly 100 components of QQQ. Everyone has an equal weighting. And what you can see, the lines, I've started these at the same point here. This chart goes back 2 years. And you can see that they usually mirror each other, as they will. It's the same basket of stocks, just a higher weighting on the big FANG stocks and the top heavy components of the NASDAQ 100. And you can see it really started to, leading up to that blow off type top in January, we had that sharp advance followed by two sharp corrections. You can see the divergence there. That was money piling into those beloved FANG stocks, Facebook, Amazon, Alphabet, Microsoft, and the likes. And we had a correction, pushed up again, had another correction. And when we zoom in here, you can see that they track together for a while. Again, when I zoom to the left of the chart, it lines those two up at the same point. So sometimes after a while, you need to do that after a correction to kind of reset things there. And you can see they tracked well together, but lately there's just been the stark outperformance of the NASDAQ 100 or the QQQ versus the equal weighted index. And that is, it's not a healthy sign for the market. It shows you that just a handful of those mega cap overweighted stocks are doing the bulk of the heavy lifting. So that's one measure of market breadth there. And when I zoom down to a 60-minute chart, because looking at that, there's very little, um, I don't want to say predictive value, but as far as a timing indicator goes, that does you no good, because what's the difference? We could see the QQQ continue to outperform QQQE for another day, another week, or maybe another month before we get the next mean reversion. But what I like to do is go down, look at the 60-minute chart, and I overlay the two, and this goes back to about the middle of May. And you can see a pattern here where they track together and then QQQ starts to diverge or outperform the equal weighted index. Right here, you can see that. You can see QQQ outperforming, QQQE underperforming. You actually had negative divergence at that high, and then boom, you had a correction. Things reset right here. They were both moving up together, and then from about this point on, you started to see some stark outperformance of QQQ. QQQE was barely making new highs, and it was certainly lagging or diverging, and then boom, your next correction. And at that point, you can see it's happened again. Now, what you have to do again, you want to reset this maybe after that second correction to try to overlay the two from this starting point. That's when that last correction ended. And you can see this stark performance in QQQ there over the equal weighted index. It's just a cycle of this outperformance. That's what the trend has been recently, followed by these corrections. And again, this is not an exact timing indicator, but coming down to this 60-minute chart gives you a better idea. You can sort of look at the frequency or the spacing between these corrections, and that's what I call mean reversion there. And we'll see if we get that again. Okay, I often use divergences in my trading and investing to look for potential trend changes, tops, bottoms, whether they're just corrections, pullbacks, or major trend changes. And as I often say, that divergences or really chart patterns are commensurate with the time frame that you're trading. So now we're going to zoom out to longer term charts. These will all be daily or weekly charts spanning years or even decades. And these because of that, these are not timing indicators. You can look at these divergences, and as I said before, the one thing about divergences is they can and often do extend until you have sort of confirmation, until you start to see a reversal. Right now, the most trend indicators are heading up, and what we're going to look at is something different. We're not going to look at momentum indicators like the MACD and the PPO and the RSI and some of those other things that I use very often in my trading. We'll look at divergences between that really show us what the market breadth is like. So in this case, we have a chart of QQQ, the NASDAQ 100 tracking ETF up top here in black. And down below, I've overlaid NAA 50R. That's the percentage of stocks trading above their 50-day moving average. Forget about that word exponential. That was a typo. This is it uses a simple moving average. So down here on the bottom, you have NAA 200R, which is the percentage of stocks trading above their 200-day simple moving average. And as you can see, what I've done on this chart is noted all the divergences, and this goes back to 2013. And a couple things stand out to me. So each and every divergent high is noted here. So in other words, you have the NASDAQ 100 or QQQ moving up in a healthy advance. The percent of stocks trading above their 50-day moving average or their 200-day are also moving up. You have more stocks. It's rising with the rising tide. But usually towards the end of a run, you start to see divergence there. You see it here in the 50-day percent of stocks above their 50-day and the percent of stocks above their 200-day, and yet a correction. Now, keep in mind, I say this a lot, that the magnitude or scope of a correction is typically, not always, but typically commensurate with the scope of the divergences or the magnitude of the divergences. So what we had here was a small divergent high. We didn't have any consecutive or previous divergences leading up to it, and that was followed by about a 9% correction. Little small divergent high, 11% correction. But what happened here at this point, we started to make a series of consecutive divergent highs, just like I've been talking about on the broad market recently. And each one, just like lately, has been followed by a small correction in line with those smaller divergences. But when you have back-to-back divergences, those consecutive divergences are really just a part of one larger divergent high. So what you had is from this point right here, let me draw an arrow, let me give you an arrow tool. So from this point here, right there, all the way up to this point here, we had a series of divergences. Each one was followed by a little correction, and then finally, the biggest drop that we've had since the bull market started back in 2009. We had a roughly 26% drop in the NASDAQ 100. Now, there was a flash crash in the QQQs. I need to clarify that. We didn't have a 26% drop in the NASDAQ 100, but we did in the NASDAQ 100 tracking ETF because this is an ETF. It's prone to flash crashes and erroneous fills and things like that. So that's what happened to QQQ. The NDX didn't drop as much, but it still had a very healthy correction then. And again, that was preceded by these large divergences. What happened then? Well, everything hunky dory. The market rallied, recovered, even popped up to a new high, but it did so with some significant and notable divergences in place. You can see that the divergences continued. The percentage stocks, both on the 50-day, above their 50-day and 200, and then boom, that was followed by another 18% drop. All right, so from that point, those two corrections cleared out a lot of bearish sentiment, tempered, the bullish sentiment, and the market, and it also helped, prices catch up to valuations, and then we started a new advance. And you can see that as in a healthy market was the case, you can see both lines rising. Um, and that's the beginning of a healthy advance. We had a little bit of a divergence there, about a 6% correction, small divergent high, small correction. Another single standalone small divergence, about a 6% correction again. Okay, no problem. We continued on up. Now, where we're at today is we've been diverging from this point back here all the way, looks like about August or so of 2017. We had divergence right there, pretty clean and clear divergence both on the 50-day percent of stocks above their 50-day and above their 200-day moving average, and we had about a 12% drop. Um, we recovered, pushed up to a new high, but you can see at that point we still clearly had divergences I've just drawn here, another roughly 12% drop. And now, we all know that the NASDAQ has chugged along, powering on to new highs, but it's doing so while still diverging. And this is just showing you the common theme for this video is deterioration in market breadth. Unmistakable, unarguable deterioration in market breadth. Fewer and fewer stocks are doing the heavy lifting. It's those more and more money is cramming into Facebook, Amazon, Apple, and the likes. Not to say that other companies aren't going up, but they're fewer and fewer participating and contributing to those gains. And again, the takeaway from this, if nothing else, I think, is that the scope of the current divergences are only rivaled by those leading up to these, 20, roughly 20% drops back then. And we haven't seen anything close to that since 2015 and 2016. So take it for what it's worth. So this is what I call a red flag, not a sell signal, but it kind of helps paint the bigger picture for when we start to see some of those longer term trend lines I was talking about on the daily charts and weekly charts. When we see those trend lines break, it can then help you shift your focus. If you're of the mindset I am, that instead of trying to buy a 3-4% pullback, buy the dips, at some point you may want to turn around and say, okay, well now we might be looking for a correction of measured, for anywhere from 10-20% or more. Okay, that was the NASDAQ. And let's take a look at the broad market. This has all your sectors in here. You have financial stocks, utilities, everything else, a lot of things that you don't have in the tech-heavy NASDAQ 100. So here's the stock market, the S&P 500. And this is a very long-term chart. This goes back to 2004. So I've done simply the same thing. This is the percentage of stocks trading above their 200-day moving average, the SPX A200R. So these are only the stocks in the S&P 500 above their 200-day moving average. It's a weekly chart, weekly time frame, and it goes again back to 2004. So you can see leading up to this point, and what these dotted lines show you are the market highs and where the divergences played out. So you had divergence, and at the end you had a steep drop off, even steeper divergence, little correction. That cleared out things, led to the next rally. Everything was good right here. The percent of stocks above their 200-day moving average was rising in line with the market. But all of a sudden, from about this point on, you started to diverge. Stocks kept going up, but the percent of stocks participating, trading above their 200-day moving average, was dropping significantly. And you can see that very sharp drop off leading up to that was the high of the last bull market that went into October 2007. There's the highs. There's the Great Recession, the Great Bear Market right there. And again, that was preceded by the correction. So without fail, and you can go back and replicate this chart. I will post all these charts on right side of the chart in static chart form if you want to take a look at them. So there it is. So along the way, since we've been in this bull market, Normally you see this line rising, but every now and then you get these divergences. And like I said, small divergences typically lead to small corrections, as you had here, 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 here. You started to have a much larger noticeable divergence. And the thing about these divergences, again, I say this often, they can continue for months and even weeks or even, I'm sorry, months or even years. And so you had this one started to play out, had a little correction. We continued to diverge, and there it was. This was the biggest correction in the S&P 500 right here back in 2015 into 2016 throughout this bull market so far. So there it is. And now at this point, you can see we've been diverging. And what really stands out to me is a sharp drop off. You know, these were about roughly equal highs right here on the SPX 200 AR, but you can see a sharp, sharp drop off since that high back in January. So yeah, the market has gone on, eked out to new highs, but you're not seeing the broad-based participation, at least not by this metric. Now here's a similar long-term chart with the Nasdaq. I'm sorry, the S&P 500 using the percentage of stocks above their 50-day moving average. Last chart we looked at had the percent above trading above their 200-day moving average. So again, it goes back to 2004. You can see the big divergence leading up to the market top back in 2007. That was the end of the last bull market there. Clearly preceded by negative divergence on that indicator. And though they're not very often that you get these, you also can use this in reverse to help identify a end of a bear market or at least a correction, substantial correction. In fact, we've only had two that stand out to me, going back to, of course, the lows in March of 2009. That was marked by positive divergence, the S&P 500 falling, and the percentage of stocks trading above their 50-day moving average on this weekly chart, making higher highs. And so these two times were, in fact, the two single best opportunities to get into the market because they came on the heels of the biggest drops right here. Of course, a bear market, and then the largest correction we had. So again, these divergences can be used either way. But right now, what we're looking at since the bull market began, we had a series, these small divergences, small corrections. Big divergence right here, biggest correction again since the bull market started. And now we have unparalleled, again, this divergence right now. It now dwarfs that divergence leading up to this drop here. And this was almost a bear market in itself in the S&P 500. Many indexes did drop more than 20%. The S&P 500 just barely managed to dodge that bullet. But you can see as we pushed up into January, we were diverging, clear divergence, and we had that sharp correction early in the year. We just recently made a new high, and you can see that the divergence is continuous. In fact, the slope of the divergence line is even more sharp now. It's more steep like it was right here. You saw that drop off just before the correction set in. So there it is. And we'll look at a couple more and wrap. Okay, so I've showed you charts that compare the percentage of stocks above their 50 and 200-day moving average in both the Nasdaq and the S&P 500. Now let's look at something different. It's another measure of market breadth, and this is the Nasdaq new high to new low ratio. So that's what you have up top. The ratio of stocks making new highs to those making new lows. It's on a weekly time frame. You can see if I don't clarify up here, there's the time frame weekly. These are the symbols on stockcharts.com. This is the NASDAQ composite down here, and it's pretty clear stuff. Again, look for these divergences. So when you see the ratio of stocks making new highs to new lows dropping while the stock market is going up, and you want to compare, you don't want to use the NAHLR against the S&P 500. You want to use it against the NASDAQ composite because that's what they're measuring here. There it is. And you can see the shaded red boxes they show you without fail. There's the divergences. You just want to sniff those out. And as you can see, as I said before on the other indicators, and this is a completely different indicator, the bigger the divergences, typically, the bigger the correction. This was the biggest drop that we've had. That was right around a 20% mark on the NASDAQ 100. And you can see it was much bigger than these previous divergent highs. This one actually may have gone off to the left here. I probably should have gone back a little farther. There may have been bigger divergence, and that was leading up to the market top. This was the market top back right here back in 2007, and there's the Great Bear Market. So you can see this was a big one. Bottom line is this right now, Uh, isn't one of the biggest yet, but it's substantial. It's bigger than these two, and if nothing else, it tells you probably, we could extend this for a while, but sooner or later we're going to have at least a decent correction. I'm talking a tradable correction, something more than a 2-3% pullback, and possibly more. And again, take this as one of many moving parts when you're doing technical analysis. This is not, I told you before, these are not standalone, they're not buy and sell signals at all, but they help formulate how much you may drop. But what you want to line this up with are things like trend line breaks, chart patterns, bearish candlestick patterns, bullish candlestick patterns for that matter. If you get, you can use this in reverse. You can sniff out the divergent lows in these indicators as well, especially after a big correction. We're in a bull trend right now, so you're not going to get many divergent lows. You're going to get those at the end of a bull market or significant correction. So right now in a bull market, you just want to look for these highs to identify the pullbacks. Okay, it's a little bit out of order. I kind of jumped, but I didn't cover this one yet. I covered the S&P 500, 50-day, 200-day, and the Nasdaq 50-day moving average percent of stocks above. So right now on this chart, we have the Nasdaq composite on top, and the Nasdaq percent of stocks trading above their 200-day moving average below. Long-term chart again goes back to 2004. I'll just brush through this one quickly and just point out that this is right now we're looking at the largest divergence on that indicator in at least, well, actually, it is the largest. I'm going back and I'm eyeballing. This goes back over a decade here. And you can see it's even larger than the divergence we had leading up to that big near bear market right here in 2015, 2016. And it's even larger than the divergences we've had leading up to the great bear market back here in 2007 to 2009. So there it is. And we're not even close to taking these divergences out. The NASDAQ might want to rally another 5-10%, but you can see this divergence line can certainly be moved up a little bit, but no matter what, we will have divergence, and anything is possible. These divergences, could they be burned out? Could we continue just straight up like this? Possible, but I think as even the most bullish bull out there would say, virtually impossible. We already have the makings of a parabolic market. I put up a chart today, and maybe I'll find that for you here in a second. Here, not to digress, but I did post this in the trading room today, and so I mentioned it. I'll bring it up. Basically saying parabolic advances typically don't end well. I mean, there are certainly differences from 1999. The companies this time around, at least a lot of the ones leading, have real earnings. Back then, you had a lot of dot coms without any true business model. They just had the name .com on there. But there are different things, and I can't even go into all the, this is another Fed bubble. This is simply another Fed bubble, just like the Fed bubble that led up to the stock market bubble, the tech.com bubble, the housing crisis bubble, and I've heard this one referred to as the bubble of all bubbles. We have everything. We have a housing market bubble, financial stock price bubble, everything else. And again, charts speak for themselves. I've traded many years, and if you guys have traded for a long time, you know that rarely, if ever, can I recall a parabolic advance in a stock or an index that didn't end in pain. It's just not healthy, not sustainable. There's the dot-com bubble that popped back in 2000. There's the bull market, and that was on a nice steady advance. But there's a top in 2007, and this is what we're looking at today. And as you can see, stock prices are going parabolic. When it ends, nobody knows. That's the thing about a parabolic run. And the other thing about it is the gains at the top, as you start to go vertical, are usually the most powerful. So we'll see. Okay, back to where I was. I think I just covered this chart before showing you that long-term chart of the Nasdaq Composite. But this, you can see again, we have the largest divergence that we've had in over a decade here. And this arrow I actually had at the time. I placed it there before the January correction. Wasn't added after the fact, and that's when we had it. So I put another arrow here. We'll have one soon, guys, and uh, we don't have anything right now. Maybe tomorrow, maybe 3 weeks from now, maybe 2 months from now, we'll get a sell signal, and there will be a lot of money to make. And why I love trading the corrections is stocks tend to fall a lot faster than they rise. You'll have months of gains wiped out in just weeks, possibly days. That much I can all but assure you. All right, we're almost done. Two more charts. We'll wrap this up. This one's the NADW, which is the NASDAQ Advanced Decline Issues on a weekly chart. And this shows you, this goes back to, this is 20 plus year chart back to the, 1997 or so. And you can see the lines that are drawn. This was the dot-com bubble. We had stocks. Down below is the NASDAQ composite. This is the NASDAQ advanced declining issue cumulative line. So you can see the AD line was severely lagging. We had divergence that marked the top of the dot-com bubble, followed by one of the worst bear markets in history. Then leading up to the highs in 2007, it wasn't nearly as steep. This was a more orderly advance into the 2007 highs, but as you can see, we started to diverge. And again, when we weren't diverging, stock prices were rising with the NAAD line. That's what you want to see in a healthy advance. And so, that was the case in some of these advances that we had early on. But it's when you start to see the divergence there between the two, between the index and any of these breadth indicators. I've used three or at least three different breadth indicators here, four at least. Um, and that's the point I'm trying to show you. It's not just one. I'm not cherry picking one indicator. And this is what we have now. We have this sharp advance in the stock market down here in the NASDAQ composite. And you can see the divergence here with the NAAD weekly making equal to maybe slightly lower highs. Even if it's equal highs, that's still divergence with the stocks moving up sharply. And the final one I'll leave is just, I wouldn't be doing my job if I didn't cover everything. There's one chart that stands out that doesn't look as bad. And here it is. This is the NAAD daily. This is one of my favorite indicators, and this is the only one that's actually not looking bad, not flashing a warning sign as far as market breadth goes. Let me point that out. So you can see I've gone back here to 2002, and again, same story. I'm just looking at divergences here between the NASDAQ composite on top with the NASDAQ rising and the NAAD, which is the cumulative NASDAQ advanced versus declining issues. So there's the divergences. Each divergent high was followed by its own correction. This was a series of three consecutive divergent highs leading up to the market top in 2007, one of the worst bear markets in history following that. Then everything was hunky-dory. The NAAD, if everything's healthy in the markets, you'll see the NAAD rising along with stock prices, and that was the case after the lows were put in. Um, in 2000, up leading to the top in 2011, we had a correction after that. There was divergence, as you can see marked there. Once again, we had the next divergence back leading up to that big correction back in 2015, 2016. There it is. And right now, we don't have divergence. So you can see we don't have a lot of this indicator is certainly not moving up with the vigor the market is. It's lagging behind, but it's not diverging. Again, this is a daily time frame. The one I showed you before was on the weekly time frame, which again, you're looking at a weekly chart on one of these indicators. It's painting the longer term, bigger picture. But this is about the only breadth indicator I could find right now that really stands out as okay. But take the evidence as a whole. There were a lot of other ones I showed you there with clear, unmistakable divergence. And I don't try to fudge these lines. If I can't draw clear divergence, then I just won't put it in there, or I wouldn't bring it up in this video. So there it is. And again, I'll post these on the site for it's public content, so you can come in even if you're not a member. It'll be under the free market content. This has been Randy Finney with the right side of the chart. I hope you enjoyed it.